Hello everyone. I'm glad you could join me for this edition of First Bank Wealth Management's Market Commentary video series. My name is Bill Dolan. I'm Senior Portfolio Manager with First Bank Wealth Management. As we move toward the end of 2017, I want to talk about positioning portfolios and checking expectations as we look forward to 2018 and beyond. No doubt 2017 has been a strong year for equities, with the U.S. stock market and many of the world market indexes up over 20% year to date, with very little volatility. Bond returns, too, have been positive, with the broad U.S. market up over 3% year-to-date and the European aggregate bond index up over 14%. Real estate is up over 10% here in the U.S. and up over 17% in the developed foreign markets. Gold is up, commodities are up. The question many people are asking is, what should we as investors be doing to position ourselves for what's next? So to answer that question, we must consider our current environment and have a view on what's ahead, informed by data and information signals and guided by experience and perspective, and to try to be rational. Let's briefly look at the relationship between asset prices and those things that drive asset prices. There are three major categories of drivers of return. First, fundamentals. Valuations, for example, price-earnings ratios, price-book ratios. This gives us a starting point, a reference point, as we look ahead as well as we look to the future, as well as giving us historic perspective. Secondly, technical factors, things like price trends, trading volumes, price momentum, market activity that is thought to be capturing the sentiment of investors. And thirdly, macroeconomic factors, economic growth, which is picking up this year, Q3 GDP up 3.3%, inflation, which has been persistently low, and interest rates, also persistently low, which is positive for investment returns, but can be expected to rise. What has been one of the most reliable indicators of the business cycle is the yield curve, a line charting interest rates from short-term to long-term. Because of the time value of money, it is typical to see short-term borrowing rates lower than longer-term rates, and the yield curve is usually shaped in an upward slope. The Federal Reserve policymakers only can set very short-term rates in their effort to support economic activity. The Fed has very limited ability to impact longer-term rates, which are instead established by and are a reflection of market activity and participants' expectation of longer-term economic strength. When we see a yield curve with low long-term rates, we can infer that the market views the longer-term economic outlook as weaker. This view doesn't always align with the view of the Fed, who may see stronger growth both near-term and long-term. The Fed's interpretation of the current economic data suggests a strengthening economy, low unemployment and GDP growth gaining steam. And when coupled with the desire to normalize interest rates, this has prompted the Fed to raise short-term rates and to signal more rate hikes are coming. The market, however, apparently sees something else out on the horizon, and long-term rates have in fact fallen this year, leading to a flattening of the yield curve. Should this trend continue, we could see an inversion of the yield curve where short-term rates get pushed higher than long-term rates. It does look like the next Fed chairman, Jerome Powell, will continue on the Fed's current path, as his economic and monetary policy views largely mirror those of the current leadership. And during recent congressional testimony, Powell said that the case for raising interest rates again is coming together. St. Louis Fed President James Bullard, however, cautions that if the Fed continues on its current trajectory, short-term rates could exceed long-term rates by late 2018, and that may be an ominous sign for the U.S. economy. An inverted yield curve has predicted the last 7 recessions dating back to the 1960s. So when making decisions about our own portfolios, we have to ask a few questions. First, can the direction and level of the macroeconomic drivers of returns be accurately predicted? Number 2, even if we can get those predictions right, can we accurately determine which of these factors will have more or less impact, and what the sensitivity of the asset prices to these factors will be in a future environment? And thirdly, should we reposition our investments to profit from these predictions, or should we instead be more strategic in our approach and build portfolios that will be robust through different environments? That's the key question, and we think it should be the latter. Long-term investors should invest for the long term and not be lulled into short-term thinking. So now a word on indicators. Alan Greenspan, our Fed chairman from 1987 to 2006, had the briefcase indicator. This was where TV news cameras would follow him on the morning of the Federal Open Market Committee meetings as he arrived at the Fed, And the theory was that if the briefcase was thin, it meant the economy was doing well and changes to policy were unlikely. But if the briefcase was stuffed full, then a move in rates was likely. This went on for years and actually influenced all sorts of trading activity. Later on, Mr. Greenspan explained that the size of his briefcase was solely a function of whether he packed his lunch that day. So thanks for watching, and I look forward to seeing you next time.